Hi, this is Dave, and welcome to the weekly market recap, closing out the week for, let's see here, it is, I'm recording this video on Saturday, March the 2nd. We're closing out the week of Friday, March the 1st, 2013. So, big news in the market this week, I guess, was the Fed came out and caused some volatility on Friday. You can see that we're still, let's start out with the daily chart of the Dow as we usually do. You can see we're still maintaining this uptrend. This uptrend is still intact. And, we were talking about two possible scenarios playing out last week where, I'm more interested in a decent pullback down somewhere to this trend line that lines up with, a 50 to 61.8% retracement of the high to low. I don't have that on the chart right now, but it lines up pretty close to this trend line and these swing points. So I'm more interested in a pullback to these levels personally, but we also have the other scenario that we've been talking about as a possible scenario for the last couple of weeks where we could just push higher into the October 2007 highs. So, the volatility that came out with the Fed speak last week, you had one distribution candle in here where we closed off of the highs. Okay, we closed off the highs there, and then we pulled back on, let me just clear this off. This one candle here on Friday, you can see we pulled all the way into the 21 period exponential moving average in, based on, announcement volatility. And then we came all the way back up off those highs, off those lows rather, off the lows. And that is terrible writing, but we closed, close to the highs. We didn't break new highs, but we closed close to the highs of the session. So that to me is indicative of, we're still essentially in an uptrend, but over the last couple of weeks, we've been sideways, but we broke out of this kind of sideways consolidation a little bit. It feels more like a tug of war than a real trend. So we've had volatility going up and down. We're so close to those October 2007 highs, which is probably creating, the sort of tug of war atmosphere, the volatility. It's not they're not clean market moves on an intraday basis. So with that being said, we're above 13,955, and we spent 3 days above that on a closing basis. So what I would expect to have happen is maybe to make a run to the 2007 highs. And then for there, I'm not, that's a major resistance level. I'm not expecting it to just, push right through there. So if we just switch over to the Dow Industrials, which will give us a better indication of where we are relative to those highs. And I just typed in an incorrect symbol twice. Okay, here we go. So that level comes in around 14,198. So we're really close to those 2007 October highs. And, at this point in time, I wouldn't be surprised if we came up and tagged those levels. And I wouldn't be surprised if we flushed all the way down, into, this kind of, confluence level that we talked about in last week's video. So let's just take a look at the sister indices. There's really not a lot to talk about except for the fact that we're pushing to one level or the other. It looks like at this point in time, based on the close of Friday, we may be pushing to the upper end of that level. I'm not really looking for a lot of upside from there, without getting a pullback first. Now, the market can do whatever it wants. So here we're looking at, the S&P futures, and if you look at this this market action, same sort of scenario where we could come up and we can test this 1618 move from this this high to that low. So if we just go back to, for example, the INDU, the Dow's the same situation. We can look at this as an extension of this sort of cup pattern. That's another way to look at this. And let me just turn on the 1272, the 1618 extensions, and you can see the 1272 comes in, you know, right around where we are. We've tested that, and the 1618 comes in a little bit higher. So if you jump over to the Dow, so it's right, you know, the 2007 highs are right in the middle of the 1272 extension of this high to this low. You know, this kind of cup pattern breakout. You know, those highs are like right almost smack dab in the middle of those two fib levels. So that's interesting. If I just go back to the Dow futures and look at the same sort of scenario, that high, this low, and actually I have these off as well. Let me just turn these on. You can see the 1618 extension comes in around 14,267 in the Dow future. So, you know, that's about the same distance as the 2007 highs on the Dow Industrials chart. So is that achievable? Yeah, I think it's achievable. There's just not a lot to do because we're so close to those levels. So let's look at the NASDAQ futures. NASDAQ futures are really, really sideways, but they're holding in and above the 618 or this high to that low. So they're still more bullish than bearish, but they're just really, really in a box play sideways. And speaking of box plays, let's just take a quick look at the transports, and then we'll look at the markets from the Darvis squeeze perspective. I don't know why I can't seem to type today. Transports, TRAN. There we go. So what we're looking at here is, you know, the transports are above, you know, this box play. They broke out above here, and, you know, they did a symmetry move from, you know, this high, this low to this high. They moved the same distance from the breakout point, and they've just been kind of going sideways, consolidating as well. Potential minor double top here, but we're still holding in above the 8-period exponential moving average and the 21-period exponential moving average. In order for that double top to confirm, we would have to break the pivot point right around there, and then I would expect to move, you know, the distance from the high to the pivot point down. You know, that would bring us somewhere into this 382% on this chart here, right in around that line there. So really not much going on there either. Let's just flip charts over to the Darvis squeeze perspective, and you can see here, this is a methodology that I've been working on for a long time. And if you look here, you can see, excuse me, here's the Dow futures, for example, on the daily chart. It's in a squeeze, and it's given a Darvis long signal. The S&P futures on the daily chart, squeeze, potential breakout. NASDAQ, same story. So when you see something like that setting up, it looks like we're setting up for some kind of a move. So let's just take a look at what those charts might be telling us. So here's the Dow. Now I'm going to start off with the weekly chart. If you look at the weekly chart, you had a signal fire back here on the long side, you know, going, now remember these are weekly bars, so you're going back, this was last week. So you've got 1, 2, 3, 4, 5, 6, 7, 8. This is a 2-month move. You the signal fired about 7 weeks ago, and you've just been chugging higher with a potential target, you know, up here, 14,700. Is that achievable? You know, anything's possible in this market, but you've already hit about 50% of the width of this Darvis box target. That's a pretty good target. 75%. You know, of the width of that move is a good target. So that's on the weekly basis. So the path of least resistance, the dominant market pressure in the Dow is definitely more, you know, to the high side. So let's take a look at the daily chart, and you know, the daily chart is really messy, but you can see here, you know, you've got blue Hakinashis, you're in a squeeze. You know, lack of volatility, although that I wouldn't really say that's really characteristic of where this market has been. But you have a potential target up here around 14,200 based on this methodology. So, you know, it's showing that there's a potential for a little bit more upside on the daily chart. If we look at the S&P futures based on this methodology, you know, these aren't very clean, but essentially the way this script should work is a breakout above this high around 14, sorry, 1530, 1531 should bring us somewhere up and around, let's see, 1480, 15, about 50, potentially up to 50 points higher. That would bring us in and around 1580 potentially. So we'll have to see if we break, the top of this box here at 1531 to see if we could get, 1560, 1580, something like that. And, is it possible? Anything's possible in this market. Just kind of keeping an eye on that methodology. The NASDAQ, I wouldn't really expect too much out of it at this point in time, but if it did, if it did break the top of this box, it's a valid signal. 2785.50, let's call it 2786, could bring us, substantially higher, somewhere into, 2850, 2900. I'm not really looking at that now. We'll take a look at this next week, hopefully, and see if we do break above this, then we can reevaluate this methodology. But if we take a look at, for example, there was a good signal, a good reversal signal on the 30-year. So I just want to take a look at that. The 30-year, this is, let me just remove some of these fibs. Now, if you look at, so here's a Darvish squeeze. You're in a minor downtrend here, and we were looking to see if we could hold some of these levels. I was actually looking for, if we broke the bottom of this box, that would have been a good short signal. But you can actually see here that, you can almost see a trend line here. This is what I call a Darvish squeeze reversal. It's when you get a Darvish squeeze signal here when you break, a down trend line. So for example, if you look at this Darvish box setting up, it set up a Darvish squeeze scenario and it broke the trend line on the breakout. And you see when it broke the trend line on the breakout, it powered through that decisively. So we're looking for downside here in this market, but we weren't getting any lower. And then the market kind of flipped the script and gave us a long signal and actually a Darvish squeeze reversal signal off of this Darvish box here on the daily chart. And it's already met the target. You can see here it met the target right up here. And when it met the target, it found resistance at the target. So the maximum target was the width of this box to the high side. So you can see that reversal signal, fired here. It fired a long signal, and, that played out nicely. The bonds had a nice, strong reversal going, this week, right into, that Darvish squeeze setup. So why did that happen? We never really know why, but I would, hazard a guess that, the Fed just doesn't really want interest rates to go higher. So, they're getting involved in these levels where they think that, they're kind of line in the sand levels. So what we were looking for didn't happen, and you can't ignore, these reversal signals when they set up. Okay. So let's jump over to what I think is really, really driving this market. Oops, that's a 1 minute chart. Let me just see here. Yeah, that's a 1 minute chart. Let me flip over to the dollar index, which I really think the dollar index is driving, this market. These were some lines that I drew on the chart, in a discussion I had with some traders in the trading room here at Market Trading Concepts, where I was looking for a pullback and then a push into the 618. Well, we ended up getting that move. Into the close on Friday. And isn't it interesting that we probed above the 618 here? And like the 618 is the line in the sand, in my opinion, the fib line in the sand between long and short of this market. So isn't it interesting that we pushed above it and then we closed right at that 618? What other way than to confuse a trader than to close right at these line in the sand levels? So I find this really, I find that really interesting how the market does that, and it just really kind of messes with the traders. It messes with traders. They're not really sure what to do based on that. So just to clarify, this is what I was looking at. I've got the fib levels from this high. Okay, you've got this high in play. Let me just grab the pen. Okay, you've got this high. You've got this low. And the 618 retracement comes in right here. And you can see we closed right at that level. So at this point in time, everything is looking everything is looking bullish. I wouldn't be surprised to see some kind of a pullback into support, but what I'm going to be looking for is to see in and around this area if we're going to hold support and then we're going to close above the 618 on the dollar index. So you can see my trending indicator is net bullish. The stochastics are in oversold territory, but they're looking like they're starting to, like when they're starting to trend, they can stay oversold for long periods of time. The MACD crossed its zero line. Okay, the MACD crossed its zero resistance line here, and it's trending higher. You can see the volume picked up a little bit. So at this point in time, I'm really cautious about this market in general, and I'm really watching the dollar index as a cue to see where this market might be going. This, to me, is the key market to watch to see, this is driving all other markets in my opinion. So let's take a look at the inverse of the dollar. Let's take a look at the euro futures. That's not the right symbol, Dave. At EC, euro futures, continuous contract. Now, isn't it interesting that, okay, let me just flip back here because I think the context and the perspective of this is really, really important. Here we have a line in the sand level of the dollar index right at its 618, right? This is right around 82.35. I would give it a range of 82.35, and I apologize, it's hard to write with a mouse, to 82.50. Okay, I think those are the key levels we need to break above in order for the dollar index to continue bullish. And this is really the upside surprise. So here's the line in the sand level here between 82.35, 82.50, right at the 618. And isn't it interesting that if I flip over to the euro, we've been talking about this $1.30 level, key level that it needs to hold for a long, long time. This has been on the chart, for months and months. And you can see here that look at what the euro did. It failed this trend line, and then it came right into the $1.30 level. That is the line in the sand level, the $1.30, and you can see that its 618, it is right in and around its 618 on the opposite side from the low to the high. So isn't that interesting that, the dollar index is at its line in the sand level, and the euro, the euro in order to stay bullish really needs to hold $1.30. So if the euro holds, let me make sure I'm saying this correctly. If the dollar index breaks above, let's say 82.35 to 82.50, and the euro decisively fails $1.30, which is its key level, then we're really looking, in my opinion, at some significant trends potentially kicking off based on dollar strength, euro weakness, okay, and all that implies. So if we look at this, excuse me, you can see the trending indicator is still positive, but it looks like it wants to roll to the low side. This should actually be red. Okay, it looks like it wants to roll. It looks like it wants to roll to the low side. That hasn't happened yet. It's oversold, just as the dollar index is overbought. But look at this, the MACD crossed over its zero line resistance to the downside. Okay, so this is something we really need to keep an eye on, and look to see if if this is going to kick something off. To me, these are the major, the dollar index is the major market to watch to see what might be happening in these markets and for macro direction. So we had bonds higher, we have US dollar strength, euro potential weakness, but they're both at line in the sand levels. At this point in time, I'd really wait for the confirmation of the break of those levels on both sides. And then we can take a look at some commodities quickly. This is all I really wanted to talk about this week. I think these are the key drivers of the market. Excuse me, but let's take a look at some markets quickly. Here's natural gas. Natural gas broke this trend line. It's really choppy, but it's starting to look a little bit more constructive on the bullish side. It's holding this low. It's broken this trend line. I don't really like it at this point in time. I think in order to get something going, we really need to get above, this swing point here at 371. And that's a far ways off. But if we broke, let's say, above 371, then I'd be looking for potentially, personally, a retest of these highs, let's say. But at this point in time, it's really in, in the dead zone in no man's land, in my opinion. Let's take a quick look at gold. Okay, gold. Gold is really, just above this key support level, 1539, and above this support level of the, these previous lows. That's kind of the zone that I'd be looking for it to hold support. If the dollar index gains strength, then we're probably going to come right into those levels and test them. And if the dollar index fails where it is right now, then we're probably going to hold these levels and push higher. That's kind of what I'm looking at from a basic intermarket kind of scenario. You've got, silver, you've got support in and around here. You've got support all the way down, to some of these previous lows, all the way down potentially to 2639. So I'm not really liking these markets. I don't think there's really much to do there. And then let's just take a look at crude oil. Crude oil broke this trend line, came all the way back down, and it's testing that trend line now. So, I think crude oil at this point in time really needs to sort of hold these levels and start pushing off in order to maintain, the bullish bias that was really triggered when we broke above this trend line here. So we found resistance at the 50%. We had major resistance around $100 to $101. Now we're all the way back down to, $90 a barrel, just over $90 a barrel. So I hope that helps. That's all I really have this week. Good trading, and I look forward to seeing you at the next update.